Thank you for listening to the Real Estate Voice podcast. This is Vernon Ari Jones, managing broker, owner of Jones Homes, and for over 30 years, we have serviced the Colorado real estate market. Mortgage rates dipped below 7% last week, with the average rate for a 30-year fixed home loan dropping below 7%. Spring home buyers are receiving an unexpected windfall, again, as mortgage rates fall below the 7% threshold for the first time in over a month. Mortgage rates have been above 7% for about 5 weeks now. So the falling might give the waning spring housing market a boost. In addition to lower rates, buyers can also expect to reap the benefits of 28 straight weeks of rising housing stock for the week ending May 18th. This past week, the inventory of homes for sale grew by 35.5% compared with last year. It was the highest since July 2020, which basically was the early days of the COVID-19 pandemic. Here's kind of like a breakdown of what we think these numbers mean. Mortgage rates. Rates dropped following the release of April's Consumer Price Index data, the CPI, which indicated a slowdown in inflation after acceleration since 2024. Recent readings on the labor market and inflation data point to conditions heading in the right direction going forward. But the path to lower interest rates may continue to have a few unexpected bumps along the way. When do they don't? Overall, though, rates might be headed in the right direction, down. The progress in inflation and labor market observed in April data will likely provide some stability in mortgage rates and may even lead to some additional declines. As mortgage rates have stopped climbing, buyers and sellers are eagerly anticipating lower mortgage rates to reignite the market. In addition to the total number of homes for sale being at 4-year highs, new to market listings also shot up by 8.1% from the year prior. Seller activity continued to climb and accelerated relative to the previous week's growth. Last week, new listings increased by 6.6% compared with the previous week of last year. Sellers are finally willing to put their houses on the market as they see rates are not going to drop down to 2 to 3%. They're not going to drop down to 4%. They're not going to drop down to 5%. But they could potentially be in that stable 6 to 7% range. Earlier in May, we saw sellers, many of whom are themselves buyers, pull back from listing their homes as mortgage rates increased and growth in new listings decelerated. However, mortgage rates have once again continued to soften. In response to rates resuming their decline, more home sellers opted to list their homes for sale as growth in new listing picked up once again. Buyers looking for the most homes to choose from should head south. South has a 43% year-over-year increase in inventory in April. Markets in the South are also primary drivers of inventory affordability, with more small and affordable homes primarily being listed in that region. Median home prices ticked up 0.6%, around $430,000. That's nationally. The slight uptick comes after 11 weeks of no or negative annual price growth. Denver Metro kind of had a 2% year-over-year gain. However, that varies depending on what market you're in, what subdivision you're in. So again, you can say location, location, location still applies. In this sense, it does. Homes spent an extra day on the market for the week ending May 18th compared with the same week last year. The typical home spent 47 days in the market in April. Recent increases in mortgage rates have resulted in both buyers and sellers acting cautiously with more homes churning at rates similar to last year for the past 3 months. Buyers should note that although home sales are slowing down, the pace is still quicker than in pre-pandemic times, as inventory has yet to return to normal levels. And when I say normal levels, usually a balanced market is around 5 to 6 months of inventory that will last that long. I mean, I think we have maybe between a 3 and a 4 month inventory. A couple things. GDP, gross domestic product, some numbers I was looking at today, was under 2% for the first quarter. I will say it's going to be interesting to see what it is for the second quarter. GDP being down under 2% is a cooling of inflation. Labor numbers are at 175,000, I believe, last week. So another cooling in the labor market. As these things start to cool, slow down, or even retreat, that's when you see mortgage interest rates start to respond downward, which is what I think we all want. Thank you for listening to the Real Estate Boys podcast. If you have any questions, feel free to give me a call. This is Vernon at 303-359-8218, or visit our website at www.joneshomesonline.com. And as always, please be safe.